With the recent surge in the China markets, we have been receiving questions on China from our community members, asking us if this rally is for real this time. So in this video, we will share with you what has happened so far, how you can get exposure to China markets, right? And most importantly, something that is not widely covered is what should we be expecting when we are investing in the China markets. So let's start off with what has happened so far, right? Earlier this year, we actually had a stock market rally in China, right, in the early part of the year. But at that time, we were expecting some policy support, but it wasn't forthcoming, and hence there was a deep pullback after May, right, where the rally actually lost steam. So, but this time around, the current stimulus plan seems different. They are finally bringing out the big guns, right? So the central bank in late September, they announced the most aggressive monetary support measures since the COVID-19 pandemic, which includes things like cutting the interest rates, injecting liquidity into the markets to support the property market. And that's where we saw the stock market actually reacted very positively in the second half of September. Now, their finance minister also told the press conference that Beijing will help local governments to tackle their debt problems. They want to offer subsidies to the people with low incomes. They want to support the property market. Also, replenish the state bank's capital, among other measures that will be mentioned. So China is clearly feeling the pressure that the economy is in a very deep, very stressed level right now. So they want to try and push the economy to accelerate, right? And so this massive stimulus that they have been sharing is a strong statement of intent that they are trying to do everything that they can to drive the economy. And right now, with the US side also loosening the monetary policy, it will be allowing China to do the same. Right. The CCP, they are trying to encourage buybacks. They want to keep the capital within China to support the yuan by reducing currency outflow. So they also hinted that more support is actually underway and we are going to see bigger packages coming. So after China's stimulus measures that were being announced, the market actually saw a very significant surge, right, up by more than 30% in just a very short 2 weeks period. So it was a very substantial move, although right now we have been seeing the pullbacks ever since that very substantial rally. So what we have been seeing so far is an everything China-related rally, where you have a rising tide that lifts all boats. But eventually those that have legs or those that will hold up will be certain sectors, right? Probably not everything, right? And looking forward, it will also take what we're looking at to sustain this upward momentum will also be firstly an improvement in earnings, right? And we also would like to see a U-turn in the economic indicators, like where we're looking at things like consumption and so on, where it is improving. So we are still looking at the fundamentals, like consumption, right? When we are placing our bets on China. So there is a possible tactical play for us to have some exposure on. But maybe you may ask, why do we bother looking at China when we can simply just invest in the US markets, where we can simply just put 100% of our growth portfolio into, say, the US markets? Now, okay, so here's the thing. For example, if I look at US tech stocks or the AI related companies or the semiconductor companies, which now everybody thinks are great. These companies, yes, indeed, they have been doing really well. They have been posting very strong earnings, strong results. They have resilient balance sheet, very positive growth outlook, and so on. So this has understandably attracted a lot of investor interest, which makes this stock look like a very ideal investment to add even more positions at this moment in time. Now, but the problem is when there's so much positivity already priced in, and the demand has driven the valuations to very high levels, then usually when the sentiment is so optimistic, even a slight shift, right, could drive a pullback, right, potentially resulting in losses for investors who are buying at elevated levels. So this is something where we've seen, right, case in point for ASML, which recently it has seen a pullback in mid-October, right, as ASML shares dropped sharply after warning on semiconductor recovery, right, where the chip maker actually cut its outlook for next year, and there was a very sharp decline in prices. It crashed by 15% in just a single trading day, wiping out about $15 billion for ASML. So this is an example that has happened recently in the US markets. Now, on the other hand, if we could allocate some capital on stocks that have already been severely beaten down, where the downside risks are rather minimal, and these companies survive, then the surprises are likely to be on the upside instead. But of course, when you are looking at China, right, we prefer to do it with a measured approach and not like a all-in into China kind of approach. So before we look at how we can gain exposure into the China market, let us first understand, what makes this recent rally stand out. So the question that a lot of people are thinking about is, has this China market really bottomed? Or maybe this recent correction, right, that has started since sometime in early October, is it a prelude to a bigger crash to come? So let's look at the charts over here for an answer. Now, we have recently seen very positive development, significant positive developments in the technical setup of Hang Seng Index. After a strong rally from end 2022, right, to the start of 2023, this part where we have very strong rally, the momentum in HSI actually faded and the index began on a downtrend. Now, why is this a downtrend? Because it is clearly defined by the lower lows and the lower highs that we were seeing, okay? So this is a very clear downtrend and the momentum of this rally actually faded. And in fact, we actually revisited the lows again at this point in time, right? The lows that was hit back in October 2022. Now, however, ever since hitting this bottom, right, things have started to take a positive turn. What we are seeing right now is that the HSI has actually shifted up into an uptrend at this moment. Okay, why is it uptrend? Because we can see very clear higher highs and higher lows as well. So this is a new uptrend. Okay, and recently the HSI has also made an attempt to test the previous high that was set at this level, okay, that I annotate as A over here. But unfortunately, this level, right, it was met with resistance. There was not enough momentum to break through this resistance level, and right now we actually have a pullback where the prices are coming back down. Okay, so this is what has happened recently. So if you look at the HSI prices, it's now hovering within a range that is marked by the previous high at level B and level C. So you can see this was the previous some of the previous highs that were made. So it is hovering between B and C. Okay, so if prices can stay above the previous high at level C and eventually build up enough momentum to break through A, right, then this would be a very positive signal for the index, showing very strong resilience and bullish momentum for the HSI. So this is something that we always teach our students to look at the charts to understand the current state of the markets. It doesn't matter what the financial media is saying, right? It doesn't matter what articles are saying, but watch what the market is doing to tell you where it is heading, okay? So we prefer to look at the charts to tell us how the market is actually doing rather than just listen to the financial media, what they are saying. So we look at the charts for clarity. So case in point, if you look at the comments that Goldman Sachs make on the China markets, it is not difficult to see that the buy calls, the sell calls wouldn't have been in the best interest for the retail investor. So throughout 2023, in the early part of 2024, GS has been mostly bearish on China at its lows, right? And following the change of tune in the recent bullish call on 7 October, so they actually had a more bullish call, and after that we actually saw the biggest drop, right, for the China markets. Okay, so this is not to say that we will not rally up further from here, but as we have always reiterated, investors may be much better off to take such reports with a pinch of salt most of the time, and you just rely on your own investing methodology. So it might be possible that we can actually have a very good run from here, but as far as China is concerned, we need to have a measured approach, right? So we probably wouldn't want to adopt a buy everything China kind of approach, right, and just keep on buying. We must also know where we want to have exposure on and where we want to stay clear from, right, as well as know when to buy, when not to buy. So we want to pick those sectors which have policy tailwinds that can benefit from the consumption trends, right? We can look at those type of companies that are more certain to benefit from the government policies, right, which is a wiser move when investing in China companies. So for example, like the Chinese consumer stocks. So we want to go to where the smart money is heading, because many institutions that are pretty much underexposed in China at this moment, and it may seem that they will start to get more overweight more on China in the months to come. But just bear in mind that for markets like China, it has a higher tendency to go ahead of itself based on its market makeup. So generally speaking, there are still less institutional investors compared to its more matured US counterpart, which means that volatility is higher because market participants behave more unpredictably. So for those of you who like to gain some exposure in China, you'll be thinking, right, should we be picking the individual stocks to invest in, or should we be buying the overall benchmark, the overall index, right? So we will say that investing in China, related ETFs, it's actually fairly reasonable now because most companies are very cheap now. In general, especially in the tech, in the financial sector, right, the consumer discretionary sector, and so on. And this is especially so if China generally is not your primary focus and you are just looking upon it as more of a tactical investment idea, then looking at the China-related ETFs could be a possible option that you can explore. Okay, so these funds, they can be purchased directly through your brokerage account. They're typically low cost as well for ETFs. Plus, it's usually a safer bet than choosing a single stock. So some examples, if you're looking at the ETFs that are listed in the US that provide China exposure, there are actually many of them. Right, some of the largest ETFs for China right now are the iShares MSCI China ETF. The ticker is MCHI, which tracks some of the biggest Chinese stocks, right? You also have the K-Web ETF that invests in the Chinese tech companies, right? Of course, there's also the FXI, right? The iShares China Large Cap ETF. And we also have the ASHR, which tracks the CSI 300 index that will give you exposure to the top 300 stocks on the Shanghai and Shenzhen Stock Exchange. So for those of you who are looking to get an exposure to China, ETFs like K-Web, FXI, ASHR, they are a great way for investors to gain exposure to some of those well-known names and the faster growing companies in China. So you will see familiar names like Alibaba, Tencent, Meituan, that is generally taking a higher concentration in K-Web ETF. That is more tech focused. Okay, then if you're looking at FXI, instead, you will also have more exposure in the financial sector as well. And then for ASHR is where you have the China A-share market, right? Where with the stocks that are listed on Shanghai and Shenzhen. So you will have also some of the financials, the industrials companies as well for ASHR. Now for Singaporeans, there's actually no need to look far. On the SGX market, we also have ETFs that are listed that can provide you with China exposure as well. So these are just some of them, right? Not a complete list, but this is a screenshot taken using the SGX ETF screener. So one of the more well-known and also actively traded one is the Lion OCBC Hang Seng Tech ETF, right? So this is one of the more well-known and actively traded one on SGX. Previously, we have also written an article on this SHD ETF, right? Which is more for a dividend play, right? So this ETF actually includes some of the 50 high and steady cash dividend paying companies listed on the Shanghai Stock Exchange, right? So these are just some examples of the ETFs that can actually provide you with exposure to the China markets. So moving forward, right, what should we be expecting when we are investing in a market like China, right? Now, I don't want to delve too much on what ETF we can buy, things like that, because that's more of the basics. You can just do so by looking at the holdings of the ETFs, which perhaps other YouTubers, influencers, they could already be sharing online, right? But instead, more importantly, I would like to share the essential takeaways and the expectations that we should be setting if we're looking to invest in China, especially if you're a new investor or you're new to China markets, right? And looking at a very volatile market like China, what are some of the key things to look out for? So I'm going to share with you 7 key pointers that may serve you well in this journey. So the first one is understand that even in a bull market, we have to expect that pullbacks can actually happen in between. Because when you have a bull market, it doesn't mean to say that the prices is going to go up in a straight line, right? Some investors, you can see that they jump into the markets, that they think that, when you have a bull market, it means that every single day the market is going to go up, or every single week the market is going to go up. But very often we will see that after several days of rally or several weeks of rally, right, pullbacks is going to happen, right? And what's going to happen for this group of investors who don't have such expectation is that they're going to have paper hands. They may feel that they're not cut out for investing. They'll feel angry, why is the market doing like this when it's not supposed to be, when it's supposed to be going up? They will get mad, right? And some of them will just sell off their positions when actually they themselves did not understand the markets that they are getting into. Now, on the other hand, for a trained investor, they know how to view such pullbacks as a potential opportunity. They want to use it as an opportunity to add on a better risk to reward setup. And when you're able to do so, it also means that you're able to have lesser drawdowns during market pullbacks, and that will set your portfolio up for a stronger performance when the next wave, the next rally comes in. All right, so this is the first thing to understand, that even in the bull market, expect pullbacks in between. That is pretty common. Secondly, if you're a new investor who has not yet learned how to do individual stock picking, you don't understand what is fundamental analysis, you don't know how to look at the numbers and things like that, it could be a wiser choice for you to start off investing in China to gain China exposure using ETFs rather than the individual stocks, right? Why? Because China markets as a whole, generally, they are more volatile. All right, so if you pick the wrong stocks, they are unsound. If the index dropped by 5%, you could be dropping by 10%, 15% for the individual stock. So, and also without going into the details, right, there could also be certain company specific risks when it comes to China companies, right? So if you invest in an ETF, it could mitigate some of the individual company specific risks by containing the losses. You could say as like, tennis, right? Or even any other, sports similar to tennis, right? You can play it in two different ways, right? Either you try and hit your winning tennis shots, so that your opponents cannot return because your shots are very strategic, very fast, right? But those are usually for the professional tennis players. On the other hand, for amateur tennis players, usually what they want to do is they want to win by not hitting losers. So they try and do simple things. They try as long as they can push the ball back as many times as they can, and they hope that by doing so, the opponent will make the mistake first, right? And then they will win the score. So what we're trying to say that, we simply try to reduce unforced errors if things are more challenging to us. So China might be a market where investors could find harder to outsteady the index because companies' specific risks can be more likely. And to some investors, the easier way to play it could just be to just buy the index itself. Okay, so this is something to consider about. Thirdly, position sizing, right? We do not go all in, right? Even if you think that the market is very cheap, we do not go all in, we buy in stages, because the markets can move where they want to move. And your best line of defense is the ability to still average down if you still have the bullets left, right? So for those people who went all in into China during the initial rally, some of them immediately capitulated, right, in the days or after the crash that we see on 8 October, 9 October over here, okay? So some advice that you read online is to keep calm during a market crash, right? That's what you always hear. But the truth is there's actually no way that you can keep calm unless you can understand that the crash benefits you. Or rather, it's easier for you to find calm and find joy in market crashes when you know how you can take advantage of it. And you can only take advantage when you still have remaining bullets left. All right. So in investing, what we find is important is to focus on risk management. And that's where the money will flow to you. Because the secret to investing joyfully comes from investing prudently. You want to practice caution. You control the price that you buy, your entry, you control your exit, you control your risk level, your position sizing, and so on. If you shift your focus from this process, right, to the money or to the returns that you want to make, then that's where things can get messed up, right? So in other words, you want to be process-oriented, not just money-oriented. Okay, the fourth one is on portfolio allocation. In addition to sizing each position that you buy, you have to determine the percentage of the total portfolio allocation for China markets that you are comfortable with. So what is the level that you're comfortable with? For some investors, it could be 15%, 20%. For others, it could just only be a 5%. So you have to decide what is the level that you are comfortable with as an investor. And why we do so is because we want to invest with a probability-based mindset instead of just a top-down approach where you think that, okay, as long as the macro conditions are good, I'm just going to, everything will be good, I'm just going to go all in and things like that, right? So in overly volatile markets, staying passive sometimes may not be the best approach. Like for example, this is the FXI ETF that you see. For someone who has actually bought in 2011, right? You will see that right now, 13 years later, you are probably just back to the same price level or even lower. Okay. So that's why in a very volatile market, it's important to adopt a probability-based mindset as well. So I believe that when it comes to investing, right, we should learn to invest in a manner where we can reasonably accept the results should things go our way and also should it not. So for example, before this China rally happened, right, in late September, we did not over concentrate on China, so much so that our growth portfolio cannot keep up in tandem with the S&P 500 as a benchmark. So this is for the growth portfolio, okay, not the dividend one. So the majority of our holdings are still in the US stocks for growth portfolio. So in early September, before the China bull run, we were about 19%, up 19%. Similar to the S&P 500 benchmark, which was up about 18%, right? So at that point in time, the US stocks were mainly doing most of the job to pull up since China at that time has not run up yet. We will of course also run the risk of underperforming should the China markets continue to plunge further, right? Although we assess that the downside risk to be more relatively contained. And eventually, when things play out for our China bets, right, plus our rotation into the US tech stocks, back during the month of September, right, we widened our gap between our portfolio and S&P 500, where we were up about 30% by the end of September. Okay, so if you ask me, investing is about constructing a range of possibilities that you are willing to accept, right? And the thing is this, as long as you can earn more when you're right and you lose less when you're not yet right, right? If it also means as long as you can get half of those situations playing out for you, then it's still worth a bet to continue doing what you are doing. Many people, they invest with the expectation that the stock market can only present them with the outcome that they want, right? So what they do is they go all in on a single stock, Nvidia, Tesla, Apple, Alibaba, okay? And they think that, okay, this is going to happen. This is the outcome that I want to see. And when it doesn't happen, right, they get into trouble, okay? So what we want to do is we want to actually take on calculated opportunities to allow us to add some upside potential, but at the same time, we want to keep this risk in check. So that is why we do not just put all our money onto a singular bet. That will increase the risk that we take on for our portfolio. Okay, the fifth point is don't over leverage. Leverage can amplify your gains, but it also magnifies your losses. So for example, if you leverage your portfolio by 1.5 times, then a 10% market drop translates to a 15% hit on your portfolio. And today's social media landscape can also heighten this risk further. So we have seen how, platforms, communities, they can create rapid surges, also rapid crashes as well, right? Just like what we have seen before in the US market with GameStop, right? The rise, the fall that is driven by the online communities. And right now in China as well, there are a lot of influencers. Like this guy over here who is called Dalan, right? Dalan, he has millions of followers on Douyin, okay? And what he has done was he has actually promoted the all-in strategies that backfire dramatically when there was a pullback, okay? So now this Dalan, right, he's now facing a lot of public backlash. He has been banned on Douyin, right, since then. And what he has told his followers to do previously was, to go all in during the market open, right, after that Golden Week holiday, which we then saw that big crash in the China markets. So this kind of frenzy, it often draws the herd community, the herd mentality, and it fuels market extremes, right? Because investors will try and mimic each other's actions, but that can be really risky. So do not over leverage, do not engage in actions like this. When we are constructing a resilient portfolio, it is essential for us to prepare for the worst days, not just only preparing our portfolio for the average conditions. So there's this quote over here. Never forget the 6-foot tall man who drowned crossing the stream that was 5 feet deep on average, right? Which reminds us that the markets, it can and it will experience deep downturns. Even if our investment thesis is sound, it may take time to be validated with possible crashes, with prolonged consolidations along the way. So if you over leverage, that can leave you to be exposed to very high losses from which recovery would then be more difficult or even impossible. Furthermore, we must understand the mindset and the cultural behavior, right, of China. Right? And I think we all know it. In China's very unique investing culture, rapid surges and prolonged extremes are particularly common. And to better understand what pulls the strings of their behavior, we can look at one of this Chinese movie. It's called No More Bets, or in Chinese, it's 孤注一掷. It was a hit when it was shown last year. Right now, it's also available on Netflix as well, for those of you who are keen to actually check it out. Now, although it was a show that dealt with scams, dealt with frauds, but there are some parallels that we can also draw that tell us how some of the Chinese actually think when it comes to money. So let me show you some of the very iconic quotes that were included in the movie, right? For example, this one. 不顾一切向前冲. In English, if you do a direct translation, right, it means charge towards money, regardless of everything, all right? Another iconic quote, 想成功先发疯. That means if you want to succeed, you need to go crazy first. 拼一次富三代. Fight once and you can secure wealth for 3 generations. All right, and finally, 因为人有2颗心, 一颗是贪心, 一颗是不甘心, right? Because people have 2 hearts, one is greedy, the other is unsatisfied. So these are some of the very iconic quotes in the movie. While it's definitely good to have a mindset bent on success, but some of them may not take a measured approach. And to them is something like, I go all in at all costs when I'm pursuing something, which leaves them very vulnerable to whether scams or the way that they deal with money or the way that they invest the money in the stock markets. And very often the nature of humans is that they want to believe what they wish for. So in China, simply invest only the money that you have and that you don't need, that you can write off. Okay. Point number 6, cultivate your mental age. Now I'm going to make a bold statement that if you ask me, if you have not yet invested in even the US markets before, then maybe it might be wise to just hold off on China markets now, because it takes a lot more emotional discipline to do well in a volatile market like China. Right, volatilities are comparatively much higher. But of course, the upside is that if you're able to exercise emotional discipline, you can invest prudently, then you are likely to do well, because most of the China retail investors, right, they act more irrationally. A lot of them, they don't have conviction in what they invest. They are just listening to what other people tell them or what the financial media say. And that's why they may also have weak hands, right? They can do loss cutting, profit taking, things like that happen very often. So it's probably not going to be a smooth ride, because psychologically, for human beings, we are wired to think twice as bad, right? Feel twice as bad about a loss as we feel about a gain, right? So and it's good in a way. The positive is that these people will provide the liquidity for you to sell near market tops, to buy near market bottoms. And additionally, if you have the knowledge of technical analysis, it also helps you to stay sane when people are FOMOing. You can still stick to your guns and don't act further. And when crashes happen, right, when you drop to a point where the odds are actually in favor of you, you tend to be less panicky. You know how to actually add on more positions as well as compared to an average investor. And finally, the last point that we would like to share with you is to expect disbelief at the start of a bull market, right? Even as we are at the early innings of a new bull market, we will continue to see news that tell us that we could be wrong. So there's going to be a lot of disbelief usually at the start of a bull market, and it's going to feel very uncomfortable to buy in. right? Where you see the opportunity. And as we go up higher, chances are sentiments will then very easily be driven by price, and we'll start to see a new narrative where people are saying that it is time to buy. Okay, but we believe it's going to take some time from now. Slowly on the ground, we are already seeing a change in tune in the last couple of weeks. We have attended talks both as a client, also as a professional intermediary by asset management companies who also kind of hinted that they will be increasing their exposure to China over the coming months. So there is some time needed for institutional investors to come on board fully and for the retail investors to reposition their portfolio as well. So I would like to think that we are still early than late. And the institutional investors especially would not want to be underexposed and be left in the dust. Now, if you look at some of the charts over here, China has long been underrepresented in global indices, right? Although it continues to be a big driver of global growth, and the valuations of the stocks are actually cheaper compared to the global to their global counterparts, the global peers. And MSCI Emerging Market Index has also dropped China's rating from a peak of 40% back in 2020 to only just a 24% recently in August, right? And going forward with the change in the investment thesis in China, we might see a rotation of the hot money coming back to China. So there is a meaningful opportunity in the current valuations. As long as the government support is forthcoming, it may be enough to take the markets further. And now it might be an opportune time to buy. So these are the key pointers to bear in mind, especially for beginner investors or investors who are new to the China markets and you are actually looking at the China markets at this moment, right? And as we approach the end of the year, we will be holding our last session of the technical analysis workshop. For those of you who are totally new to TA and you would like to learn more about it, you are welcome to join us on 17 November, which is a Sunday afternoon, for an in-person workshop where we will teach you how TA works, how you can actually apply it to identify favorable buy and sell prices where the odds are more in our favor. So our goal is to actually apply TA to make more informed decisions rather than to rely on just impulsive trades that are made based on your emotions. Okay, so you can actually scan this QR code on the slide over here or go to this link over here to find out more details about the workshop and to save your seat. So I'll also put out the link in the description box below. Right, and with that, see you again in the next video.